Hello and welcome to the Joe DeLisi Financial Advisor Podcast. Today's title, Huge News in Presidential Election, Is It Time to Panic? Panic. It's a normal human emotion, especially when we think that this time is different. And sometimes it is different, but does it pay to react? Does it pay to panic? Now, today we're going to dive into a topic that's especially relevant in our unpredictable times, the benefits of not panicking during major world events. I mean, let's face it, the world is full of surprises. At the time of this recording, it has been widely reported that Joe Biden is withdrawing from the 2024 presidential election, which is an unprecedented event from a timing issue in a general election. And this is just a week after former President Trump had the assassination attempt. There is a lot going on, and it does feel very different, and really, it is different. Already, I've had people asking me, like, what happens now in the stock market? Last night, I was playing ice hockey, and I had a buddy of mine say, hey, what's going to happen on Monday? Because really, from geopolitical events to economic upheavals, there's always something happening that can send shockwaves through the stock market. But what should you, as an investor, do when the headlines are filled with doom and gloom? Should you sell everything, run for the hills? Should you go to cash, buy gold? Is there a better approach? We're going to explore why staying calm and not panicking can actually be one of the best strategies you can employ. We're going to look at some historical data to understand how the stock market has reacted to major events in the past and what lessons we can learn from these reactions. So to kick it off, let's look at some of this data. And we're just going to use the S&P 500 index showing performance following various major geopolitical and historical events, just to get some raw numbers. Again, this is just, one index. It's not all of the different markets that I might have somebody invested in, but it's just for brevity's sake, we're going to use this one. And this data is going to cover everything from the German invasion of Poland and France in 1940, really 1939 and 1940, to the recent invasion of Ukraine in 2022, and even the attack on Israel in 2023. So when Germany invaded Poland and then invaded France on May 10th, 1940, the S&P dropped a staggering basically 20% over the next month. Investors at the time, they must have felt the world was ending because it kind of was, from that perspective and from that time. But what happened next? Well, over the following 12 months, after that 1 month loss of 20%, the S&P 500 was only down about 6%. So in that same era, the Pearl Harbor attack on December 7th, 1941, that caused an 11% drop in the S&P within a month. Yet within a year, the market had actually gained 4.3%. So these examples highlight a very crucial point. While in the immediate aftermath of major events, that often results in really big market downturns, the longer term picture is just much more nuanced. So let's also look at some events with the S&P 500 returns after like a month, 3 months, after big events. So after 1 month after a major geopolitical event, we see typically a decline of about 1.2%. After 3 months in a major event, there's been a slight gain of almost 1%. After 6 months, we've got a gain of almost 3%. And then over a year on average, after a huge political or geopolitical event, we see a gain in the S&P 500 of over 7%. Now, what's particularly interesting is the percentage of times the market was higher after these events. 1 month later, the market was up 43.6% of the time. 1 month later. But as we extend the time frame, the percentage of positive returns actually goes up. So after 3 months of a big event, 64% of the time the market's higher. After 6 months, 60% of the time the market's higher. And after 12 months, again, about 63% of the time the market's higher. Now, let's look at a couple more examples rather than just looking at, World War II era. So how about North Korea invading South Korea, June 25th, 1950? When that happened, the market dropped almost 11% in a month. But 12 months later, the S&P 500 was up 28.8%. I use this one a lot. The Cuban Missile Crisis in October 1962 caused a 2.7% drop in the S&P 500 over the next month. That's actually surprising to me. I would think it'd be a lot more. You're on the verge. Everyone knows you're on the verge of an actual end of humanity event, and it only dropped 2.7%. 6 months later, the market had surged by 20.7%, and after a year, it was up almost 30%. Now let's talk assassination, because this is in the news. The assassination of President John F. Kennedy on November 22nd, 1963, led to a 2.8% drop in the market within a month. Again, that seems very, very low to me. Yet within a year, the S&P had actually risen by 23.7% in one of the darkest times in our nation's history. The Six-Day War in June 1967 with Israel caused a slight drop, again, 1.5% over the next month, but the market rebounded strongly, going up 13.5% in 6 months and over 25% after a year. I'm throwing a lot of data at you, but I'm really trying to get you the things that happened and how bad these things were. More recent history, 1987 stock market crash known as Black Monday. S&P dropped 21.5% in one single day. Yet by the end of the year, the market had recovered. By the end of the year, posting a positive return of almost 13%. Now, let's get even more recent. Global financial crisis of 2008. I was in business during this time. I was about 10 years in. It was a severe shock. The S&P 500 fell 16.8% in the month following Lehman Brothers collapse. However, those who held their investments saw a significant recovery with the market up 6.4% after 12 months. Huge swing there. And to get people to stay in, I remember, was very, very difficult. It's my hardest job is to get people to stick. Boston Marathon bombing, April 15th, 2013. I was actually speaking at a financial event when this occurred. And we had a 2.5% drop in the S&P within a month. But after 6 months, up 12. After a year, up almost 18. Super recent history, that's an official term, when Russia annexed Crimea in February 2014. Market dropped about 1% in a month, was up 15.6 a year later. Brexit, June 2016, about 5% drop in the market. Market recovered, posting a 15% gain after 12 months. So let's talk about the psychological aspect of investing during crises. And we're probably, this is, again, timely. It's natural to feel that fear and uncertainty. It's just human nature. I feel it too. But seasoned investors know that volatility is just a part of the market's nature. Warren Buffett, one of the most successful investors of all time, famously said, quote, "Be fearful when others are greedy, and be greedy when others are fearful." So by maintaining a long-term perspective, you can avoid the pitfalls of panic selling. Diversifying your portfolio, having a solid plan, sticking to your investment strategy, it's going to help you navigate through the turbulent times. It sounds boring. Investing should be boring. It shouldn't be sexy and exciting. Look, history teaches us that while markets do react to major events with initial drops, they often recover and even thrive in the long run. In the long run, we're looking at like a year out. I'm not talking about 20 years out even. So what's the key takeaway? In light of, again, the reporting that Joe Biden is leaving at kind of an advanced date in this election cycle, and after the assassination on former President Trump, what do? We stay calm. We avoid knee-jerk reactions. We keep our focus on the bigger picture and your plan. And again, after the recent assassination attempt on former President Trump, coupled with Joe Biden's withdrawal, both within a week, I really think this is the best and most timely advice I can offer. I hope this helps. And now for the compliance part. Registered representative and financial advisor of Park Avenue Securities, LLC, Pass, OSJ, 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License Number OD34103. This podcast is for informational purposes only, not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and opinions stated are their own. Guardians, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. Diversification does not guarantee profit or protect against market loss. 2024 178245 expires July 2026.